Hey there, welcome back to our channel Grow Your Wealth with your friend K. Anand. Have you ever wondered why so many financial advisors stress the importance of starting to invest at a young age? It's not just because they want to get their hands on your money sooner rather than later. No, the secret lies in something much simpler: time. Here's a scenario for you. Imagine embarking on your investment journey at the tender age of 25. You decide to put aside $100 every month into the stock market with an average annual return of 7%. Fast forward 40 years, when you're 65 and contemplating retirement. By this time, your investment would have grown to a whopping $314,000. Now, let's change the parameters a bit. Suppose you wait until you're 35 to start investing, but you stick with the same $100 every month and the same 7% return. By the time you're 65, your investment would have grown to only around $138,000. So, what's the difference between these two scenarios? In both cases, you invested the same amount each month, but starting just 10 years earlier resulted in more than double the final amount. That's a difference of nearly $176,000. The key takeaway here is that the earlier you start investing, the more time your money has to grow. And this isn't just about stashing money under your mattress or in a regular savings account. We're talking about investing your money where it has the potential to grow and compound over time. And that's where the magic happens. It's not just your initial investment that's working for you. It's also the interest you earn on that investment, which then earns interest on itself, and so on. This is the power of compounding, which we'll delve into more in the next scene. As you can see, starting just 10 years earlier can make a massive difference. That's the power of early investing. Time is truly money when it comes to growing your wealth. So, why wait? Start your investing journey today. So, what's the secret sauce that makes early investing so effective? It's something called compounding interest. You see, compounding is the financial equivalent of a snowball rolling down a hill. As it rolls, it picks up more snow, growing larger and faster with each turn. Similarly, when you invest money, it can earn interest, and over time, that interest also earns interest. This is the magic of compounding interest. To better understand, let's consider an example. Imagine you've invested $1,000 at an annual interest rate of 5%. After the first year, your investment has grown by $50, making your total $1,050. Now, here's where the magic happens. In the second year, you don't just earn interest on your initial $1,000. Instead, you earn interest on the full $1,050. That's an extra $2.50, bringing your total to $1,102.50. It might not seem like much, but as the years go by, these small amounts start to add up. That's because each year you're earning interest on a larger and larger amount. And if you're regularly adding to your investment, the effects of compounding become even more powerful. Just like how a snowball grows faster if you keep adding more snow, your investment grows faster when you keep contributing more money. This is why starting to invest early is so beneficial. The more time your money has to compound, the more it can grow. Even small amounts can turn into substantial sums over time. But remember, Compounding is a double-edged sword. While it can significantly boost your savings, it can also amplify your losses if your investments perform poorly. So it's crucial to invest wisely and diversify your portfolio to spread the risk. Compounding allows your money to grow exponentially over time, especially when you reinvest your earnings. And that's the magic of compounding, a secret ingredient to grow your wealth. Let's put this concept into a real-world context. Picture two friends, Sarah and John. Both are eager to invest, but their strategies differ. Sarah decides to start investing $200 per month at the age of 25, and she sticks to this plan until she's 35. That's a total investment of $24,000 over a decade. John, on the other hand, decides to take things slow. He waits until he's 35 to start investing the same $200 per month, but he continues this routine until he's 65. So John ends up investing $72,000, triple what Sarah invested. Now here's where things get interesting. Let's assume both Sarah and John earn an average annual return of 7% on their investments, a reasonable expectation for the stock market over the long term. By the time Sarah is 65, her $24,000 investment has grown to approximately $415,000. That's right. Despite only investing for 10 years, Sarah's early start and the power of compounding have allowed her investment to skyrocket. Meanwhile, John, who invested consistently for 30 years, ends up with around $212,000 by the time he's 65. Although he invested more money overall, he has less to show for it at the end of the day. So, what's the takeaway from Sarah and John's story? It's simple. Starting your investment journey early gives your money more time to grow. The longer your money is invested, the more time it has to earn interest on interest. And that's where the magic of compounding really shines. Remember, every year, every month, and every day counts when it comes to investing. The sooner you start, the better off you'll be. Sarah invested less money overall, but ended up with more because she started early and let compounding do its magic. Now that you understand the benefits of starting early and harnessing the power of compounding, let's talk about how you can get started on your investing journey. The first tip is educating yourself. Investing might seem complex, but it's not rocket science. There are countless resources out there, from books and podcasts to online courses and seminars, that can help you understand the basics of investing, risk management, and long-term financial planning. Knowledge truly is power when it comes to investing. The next step is to start small. Investing isn't just for the wealthy. Even if you only have a few dollars to spare each month, you can start investing. The key is consistency. Regular contributions, no matter how small, can add up significantly over time thanks to the magic of compounding. Once you've started investing, the next step is to diversify. Putting all your eggs in one basket is risky. Instead, consider investing in a mix of assets like stocks, bonds, and real estate to spread out your risk. You can also look into low-cost index funds or exchange-traded funds, ETFs, which are designed to track the performance of a specific market index, providing instant diversification. And finally, stay disciplined and patient. Investing is a marathon, not a sprint. There will be ups and downs along the way, but it's important to stay the course and focus on your long-term goals. Avoid the temptation to time the market or make impulsive decisions based on short-term market fluctuations. Remember, the most successful investors are not those who pick the hottest stocks or time the market perfectly, but those who start early, invest regularly, diversify their portfolio, and stay disciplined over the long haul. Investing is a long-term game, and there will be ups and downs along the way. Focus on your long-term goals. And there you have it, folks. We've traversed the rewarding landscape of early investing and unveiled the magic that is compounding interest. We've seen how time, when coupled with consistent investments, can yield substantial growth for your wealth. We started our journey by understanding the importance of starting early. We saw how a 10-year head start could almost triple your returns, showing us that time really is money when it comes to investing. The earlier you begin, the more time you give your money to grow and multiply, leveraging the power of compounding interest. We then demystified compounding interest, the secret sauce that supercharges your investments. It's not just your initial investment that earns interest, but also the interest that you've previously earned. This creates a snowball effect where your wealth grows exponentially over time, especially when you reinvest your earnings. We illustrated this with real-world examples. We met Sarah and John. Despite investing 3 times less than John, Sarah ended up with almost double his returns, all because she started a decade earlier. This goes to show that it's not just about how much you invest, but also when you start investing. Finally, we shared some tips on how you can embark on your investing journey. It's important to educate yourself, to start small and be consistent, to diversify your portfolio, and most importantly, to stay disciplined and patient. Remember, investing is a marathon, not a sprint. The benefits of starting investing at an early age and harnessing the power of compounding interest are truly transformative. By starting early, being consistent, and staying disciplined, you're not just saving money, you're building wealth. So what are you waiting for? The best time to start investing was yesterday. The second best time is now. Take the leap, start your investing journey, and watch your wealth grow over time. Thanks for tuning in. Don't forget to like, subscribe, and hit that bell icon for more investing tips and tricks. Until next time, happy investing.